Hey guys, welcome to my channel. Today we're going to be going over payroll taxes. First, I'm going to start by teaching you guys what payroll taxes are. Then we're going to go over the types of tax systems used in the United States of America. Finally, we're going to dive deeper into how each of the three main tax systems work. Payroll taxes are a type of tax that the government takes out of your money because it's how it works. That means when you get paid, a certain amount of your paycheck is automatically sent to the government before you even see the paycheck yourself. Like, say you were working or you were working at the beach as a lifeguard and just waiting for the prize of $400. But when you see your check, no, 313.57 cents. What happened? Payroll taxes. These taxes are important because they help fund many of the services and programs that make our communities better and safer. But they could also be a disappointment to people who don't know about them. But that's not going to be you because you're watching this video right now. Some of the money collected through payroll taxes goes towards building and maintaining roads, bridges, and public transportation systems that people use every day. Payroll taxes also help fund public hospitals and healthcare programs that provide services to those in need. In addition, they support programs like Social Security and Medicare, which help people when they retire, become disabled, or need health care as they get older. Payroll taxes also contribute to unemployment insurance and other safety nets that provide temporary help to people who lose their jobs or face financial hardships. By collecting payroll taxes, the government can keep these essential programs running and make sure that support is available for people across the country. In short, while payroll taxes reduce the amount of money you take home from your job, they play a big role in funding the services and systems that benefit everyone in society. Now let's talk about the three main types of tax systems: progressive, regressive, and proportional. Progressive taxes are the most common and consist of higher paid individuals paying more taxes than lower paid ones. A progressive tax system is a way of collecting taxes where people who earn more money pay a higher percentage of their income in taxes compared to those who earn less. This type of system is designed to be fairer by taking into account a person's ability to be able to pay the taxes. In a progressive tax system, income is typically divided into brackets or ranges. As your income increases and moves up into a higher bracket, the rate at which that portion of your income is taxed also goes up. For example, someone earning 30,000 per year might pay a lower tax rate on their income, while someone earning 300,000 pays a higher rate on the portion of their income that exceeds certain thresholds. Importantly, the higher rate only applies to the income within that higher bracket, not to all of a person's income. These this system aims to reduce more income inequality by ensuring that those who have more financial resources contribute more to the funding of public goods and services. The money collected through uh, progressive taxes helps support essential government programs such as education, healthcare, infrastructure, and welfare assistance. Progressive taxes are widely used around the world because they are considered more equitable than flat or regressive tax systems. They help balance the needs of a society by easing the financial burden on lower income individuals while still generating enough revenue from higher earners to fund important public services. A regressive tax system is one where lower income individuals end up paying a higher percentage of their income in taxes compared to higher income individuals, even though the dollar amount paid may be the same or lower. This type of tax system is considered less equitable because it places a heavier financial burden on those who already earn less. In a regressive system, the tax rate doesn't increase with income. Instead, it often stays the same for everyone, a flat rate, or may even have a disproportionate impact on lower earners. A common example of a regressive tax is a sales tax or consumption tax. Everyone pays the same rate on goods and services, but because lower income individuals spend a larger portion of their income on necessities, the impact on the lower income worker is much greater relative to their total income. While the dollar amount may seem equal, the percentage of income lost to taxes is higher for the person earning less. Regressive taxes are less common as a primary method of collecting income taxes, but they are still widely used in other areas, like sales taxes, excise taxes on gas, cigarettes, and alcohol, and fees. Critics argue that regressive systems increase inequality, while supporters claim they are simpler to implement and can encourage saving or investments by higher income earners. In summary, a regressive tax system often results in lower income individuals carrying a heavier tax burden relative to their income, which can make it more difficult for them to meet basic needs and save for the future. A proportional tax system, also known as a flat tax, is where everyone pays the same percentage of their income in taxes, regardless of how much they earn. This means that whether someone makes 20,000 a year or 200,000 a year, they both pay, for example, 10% of their income in taxes. So the lower paid person would still have to pay $2,000, while the higher paid person would have to pay the entire salary the lower paid person makes. And the higher paid person would still have like 10 times the amount of money as the person that makes less money. The main idea behind the proportional tax system is simplicity and fairness. Everyone is taxed at the same rate, so no one is treated differently based on income level. Supporters of proportional tax systems argue that they're easier to understand, simpler to enforce, and can encourage people to work more or invest without worrying about higher tax rates. However, when the rate is the same for everyone, the impact on individuals can be very different. For example, 10% of 20%, 200,000 is $2,000, which might significantly affect a low-income earner's ability to pay for essentials like food, rent, or transportation. On the other hand, 10% of 200,000 is 20,000, which is a larger amount but may not drastically affect a high-income earner's lifestyle. This is why some critics argue that proportional taxes are not truly fair. They may seem equal on the surface but can have unequal effects on people's lives. Proportional tax systems are less common for income taxes but may be used in some countries or proposed as an alternative to progressive systems. They are more often seen as certain types of local taxes or specific national tax policies where uniform rates are applied to all taxpayers. In summary, a proportional tax system applies the same percentage rate to all incomes, making it a straightforward and uniform tax system. But it can raise concerns about fairness, especially in how it affects low income individuals. Uh, that's it for today. Thank you for watching and see you in my next video.